Another video, as I promised, I'll be making on put options. Last video I made on call options, covered call options. Today I'll be making a video on put options, which is very fantastic way to make money. Money. Are you guys ready? Did you like my last video? Let me know. Comment, like and subscribe to my channel Stocks with GS. Alright guys, let's go. Another way to make money, easy money. Put options selling is the best. I love this. Selling put options and make enough money without much risk. Alright guys, options. Put options. Okay. What are put options? Before I go to put options, I should let you know that you have to use margin to optimize most of the money by selling put options. Let me explain you what margin accounts are first. Then we'll go to put options. Margin account. As the name suggests, margin. So if you have $100,000 in your account, so you can do trading worth 100,000 only, but they give you a leverage, they give you a margin. So you need to use the margin in selling the puts. That way you can make more money, your return will be higher. And okay, by selling, when I tell you about the puts, then you will understand what I mean by using the margin. So margin is the amount of money they hold for doing a trade. If you do a trade, they don't use your all the money. Like suppose you do a stock for $100 for $10,000. So they keep only $1,500 of your money. They hold only $1,500 of yours. And they let you do trade for $10,000. So that way your return is on your investment, and your investment is $1,500 only. So that is called margin money. So margin money account, all brokers offer you margin money accounts. There is no minimum. Robinhood can let you do, like even if you have $5,000, so they let you do the margin account. So if you have an account, two kinds of account. One is cash account, one is margin account. So on your IRA, Roth IRA, you cannot do margins. On your regular brokerage account, you can apply for margin account. So they'll give you margin. So you have to fill up little bit of questionnaire and simple questions. So if you're doing options for 5 years, 10 years, just put there 5 years, 10 years, whatever. So then they will qualify you for opening a margin account. Alright guys, and you have to be qualified for trading in options. So let's go. I'll be talking about margin account when I do the put options. Okay, so let's do put options. Last time I explained you what are the call options, covered call, how you can make money by selling call options. But you have to have a stock to sell a covered call. But this is put options. Put options are the opposite of call options. Call options, somebody is like the stock is $100. Somebody is betting that the stock will go up 120. So they buy call options. This is another way. Somebody thinks that the stock is going to go to $80. They bet for the stock to go down to $80. So they buy a put options. That is a bearish bet. So they feel that in 2 months time or 1 month time, the stock will go down to 80. So they will make money. If the stock goes down, they will make money. So they have to buy a put. So they buy a put and pay you a premium, like they used to pay you a premium on call options. Now they pay you a premium for buying a put option. Okay, if they buy a put option for 80 will be the strike price. Okay, this is the current market price. This is the strike price, $80. They pay you a premium of say $3 again. $3. So $300 for one contract that contains 100 shares of a company A. Okay, they buy a put for $80 strike price with expiration of, let's do January 16, 2026. Same time again, which I told you about the calls options. $80 is the strike price. They buy a put option for this stock A, which is right now quoting $100. They buy a put call, a put option for $80 strike price. They pay you $3 premium for January 16, 2026 expiration date, and they pay you this money that if the stock goes beyond 80, like 70, 60, the difference between 80 and 70, that will be their profit. That will be their profit. Okay, that gives them a right. Buyer of a put option gives them a right to sell the stock, this stock A, for $80 to somebody and get $8,000. So that is the right of a put option buyer to sell. Suppose I am a put seller, he's a put buyer for $80. I get $300 premium. He gave me $300 as premium. Okay, so that binds me to buy this stock from him at $80 before or on January 16, 2026. So I have to buy this stock from him at the price of $80. If he wants, it is his right and it is my obligation to buy this stock for $80 anytime he wants until January 16, 2026. If the price stays above 80, goes 81, 82, 83, 84 or 100 or 102, whatever, then this premium is mine and January 16 comes, nothing happens, his put option goes to zero. So he loses all the money if the price stays above $80. You got my point? So if I sell a put for $80 and somebody buys a put, so he pays me $3 premium for 100 shares, $300. So I take $300 and I make a bet that if the price comes to $80, I will buy this stock from you for $80. This is obligation of a seller of a put. Okay, so my obligation becomes his right. His right to sell me the stock for $80, even if the price is 70, 60, 50, 40, or even if the price is zero. I'll have to buy this stock from him for $80. That is called strike price. Okay, so I give you now example how you can make money by selling puts. Okay, I give you an actual example like AMD. Again, AMD, the stock, you remember? Let me use another pen. AMD price $255 today. $255, okay? Suppose I feel that this company is doing very good. This is a bullish call. If you sell a put, that means you are bullish about the stock. So I'm very bullish about the stock AMD. So one way to make money from AMD is you buy the stock of AMD for $100, for $255, you have to pay $25,500 for buying 100 shares, right? You need $25,000. Okay, if the price goes to from $255 to $245, I lose $1,000, right? If it goes to $240, I lose $1,500, right? Agreed? You are with me? Okay, so if I don't want to lose the money and I don't want to take more of a risk, I feel that this stock of $255 is good. I want to buy AMD, but not at $255. I think the price, I want to buy this for maybe $220. If it comes down to $220, I would love to buy it. Then what you can do is you can sell a put option for AMD. You can sell a put option for AMD for strike price of $220, January 16th 2026 is the expiration date for this. You sell a put option for this AMD whose market price is 255. You sell this put for 220. One contract is 100 shares. So you sell a put for 220, and then the buyer of the put, because the buyer thinks that the price is going to go down 220, they do the hedging or whatever, don't think why they are buying a put. So they will pay you a premium, okay? And today I'm going to tell you the actual premium for a strike price of 220 on January 16th. I did a deal today. I did a trade today for this stock for AMD. I'll put a screenshot of my trade on this. Okay. And they paid me $11 per share. So that is $1,100. So buyer of a put pays me $1,100. I sold him the put for $1,100 with a contract that if the price comes to 220, I will buy AMD from you for 220 on or before January 16, 2026. So I don't need to have a money in my account right now. Okay. I'll explain you how you can use the margin. Normally the cash secured in your IRA account, you have to have $22,000 in your account to do this deal, because if the price of this stock comes to 220, you have to come out with $22,000 to buy 100 shares of AMD for 220. So you need $22,000. But in margin account, what happens? They don't want you to have 22,000 in your account. They want you to have, there is a formula, they calculate the margin money. They keep some of your margin for you to do this trade. Okay, most of the companies, they do a trade 10% of this amount. This is $22,000, right? 10% of this is $2,200, right? Plus they add this premium to this, $1,100. So your total investment is $3,300. This is called margin. They keep your margin, they hold your margin. So this deal needs a margin of $3,300. So your investment, you have to have $3,300 in your margin account to do this deal. But in case the price comes to 220, then you will have to come up with more money. So you should have some more money sitting in your account or somewhere, that anytime he wants to sell you the share for 220, you will have to buy this stock for 220, or you can scare off the deal. Okay, so you get a premium of $1,100 on your investment of $3,300. So this strike price is too close because you get $1,100 for this. Okay, if you want to be safe, that I don't want the price to come to 220, I don't want to spend $22,000, then you can go to 200, you can go to 190, you can go to 180, you can go to 150. In 2.5 months, if you think AMD is not going to come down to 150, you want to completely risk-free, you don't want to spend $22,000, then you can sell the put for 120. Obviously, then the premium, you will not get $11, you might get $3. In 200, you get $300. For selling a put for 150, you might get $300 only. But because 220, 255 is close, so it's possibility that 255 stock can come to 220. So you will have to buy this stock for 220 even if the stock is 150. If you sell a put for 220, you will have to buy this stock for 220. Anytime he wants, the buyer of the put wants. So in normal circumstances, if you feel the stock is going up and you are bullish about the stock, then you always sell. AMD is a very hot stock. It is doing very good. It has doubled in the last 3-4 months. And I expect this stock to go up unless the market goes bust. Okay. So 220 is the price where I'm comfortable buying this stock for. So I will sell a put for 220 and get $1,100 premium to keep. If the stock price doesn't go to 220, I keep $1,100. Okay, my investment is $3,300. I make $1,100 on $3,300. So what is my investment? 33% return on my investment of $3,300 if the stock price stays 220 or above. So I make 33% return in 2.5 months, right? So that is about 14% per month. Annual, you can count, it is like 170% return on your investment. So if you are okay with like 100% return or 80% return, 70% return, then you go to 190, 200, 180, 150. You go down, you make $300 with 33. If you go to 150, this is approximate. This is not exact $300 because this is 11 is for sure because I did a deal today. I did a trade for $11. So if you want to make $300, you can sell AMD put for 150. So then your obligation will be to buy this stock. If it comes down to 150, you will have to come up with $15,000 to buy this stock and you keep $300 premium. If it doesn't come to 150, this is safe, like 98 or 99% safe that you will get $300 and the price is not going to come down to 150. Okay, but it depends how you choose the price of a stock and expiration and the strike price. So you make money. Got it? I'll give you another example. I'm giving you actual examples today, okay? So there is another company called Micron. This is again another hot stock which has appreciated by like 80-90% in the last 3-4 months. It's a chip making company. All chips making companies are very hot these days. Today's price $225. $225. So again, if you go January 16th, 2026, and you think that this might come to 200, it might come to 190, but if it comes to 170, I will buy this stock. If you feel safe at 170 that it's not going to come down to 170, its price is going up, up and up. So let's do it. Sell a put for Micron. MU is the symbol. Sell a put for Micron for how much price? Strike price of 170. 170 for January 16, 2026. And the actual premium is $5.40. That is $540 for one contract of 100 shares. So you get $540 premium for selling a put of Micron for January 16, 2026 expiry with a strike price of 170. What does it mean? It means if by January 16, 2026, the price of Micron stays above 170, even if it goes, if from 225 it comes to 171, you still make $540. You don't have to do anything. January 16 comes, bye-bye. Money is in your pocket. They give you upfront $540 to buy a put option for Micron for a strike price of 170. So $170 is the strike price. You get $540 premium. So what a deal, because the chances of Micron from 225 coming to 170 are very, very less. They give you a percentage. It's a 10%, 15%. That is called delta. I'll explain you sometime. You can take a help of these Greek symbols. So if the delta is 15, that means 15% chances of this to go here. They calculate like computerized. So if delta is 10, there's 10% chances of this hitting 170. It's like that. Okay. So now let's calculate the margin, because the strike price is 170. So how much money you require in the margin account to do this deal? to earn $540, how much money you need? 170 is $17,000, right? $17,000. 10% of 17,000 is 1,700. Plus you add this premium, 540. So 2240. Okay, your investment is 2240. You have to have $2,240 in your account, $2,240 in your account to make $540. So for 2.5 months, it comes out to be 240, 540, it comes out to be 24% return in 2.5 months. Okay, so which is about, I would say, 10% per month, 120% per annum. That is your return. And what is the security? How much secure this is? From 225, this Micron stock has to come to 170. If it stays above 170, you make $540 with an investment of $2,240. $2,240 you keep in your account. That is a margin money you have to have in your account, $2,240. And he gives you $540 in advance. And January 16 comes, the price stays above 170, you keep $540. Deal is finished. And worst scenario, if the price comes to 170, you have to come up with $17,000 to buy this stock of Micron, 100 shares of Micron for 170. So $17,000 you have to come up. You still keep 540, but you have to come up with $17,000. Or you can scare off the deal and pay the difference or receive the difference, whatever. Even if it comes to 170, you are breaking, you still make $540. So you will lose money if the stock price comes from 170 minus 540. 164.60. So if the price of Micron comes to 164.60, then you break even. If it goes below that, then you will have to pay the difference or take 100 shares of Micron at $170 by paying $17,000. But still 540 is yours. What a deal. So you can select a price of the stock, strike price. You can select. If you think 170 is too high, it might come from 225 to 170. You are okay to make like 50% return for the whole year, not 100%. So you can go to 150. So instead of 540, you might get $400 if you go to 150. If you go to 140 strike price from 225 to 140, then you might get $300. So you still get premium. The premium goes lower if the strike price is lower. Strike price keeps going lower, the premium for the put keeps going lower, because the chances of 225 going to 150 are more than 140 or 130 or 120. You can sell it for $100. Okay, you still make money. So for me to make money, I go with a strike price which doesn't hit. So I pick up the stock which is expected to go higher. That is a bullish call. So this 225 should go to 230, 240, 250. So my 170 gets more secure. And this premium keeps going down. Like 1 month gone. This is tradable. This $1,100 which I got, this is tradable. Okay. If 1 month goes and still price is 225, then this 1100, I can get out from this 1100 by keeping $500. And this approximate, okay. So buying this back for $600, I sold it for 1100, I can buy it back for $600. So I make $500 in 1 month. And I get out of it. So I can get out anytime I want. Okay. If the price goes to from 225 to 250, next day, like tomorrow, then this 1100 goes to 700. So you make $400. You want to get out? Make $400 in one day, get out. Or you wait for January 16 to get the whole $1,100. That is how selling of a put works. Okay? I give you another example of another stock. You remember I gave you in the call option, I gave you a stock, HIMS. Price today was 44. Okay? If you think this was $68 price stock. About a couple of months ago, this was 68. Now it is 44. If you think that this is a good buy, or if you think it might go a little bit more low, so what you can do is you can sell HIMS put for, I have calculated, I sold it for $32. Same January 16, 2026. I sold this put for HIMS. Price $44. I sold this for a strike price of $32. And how much premium I got? I got 1.75, $175. I got $175 premium that will be mine if the stock price of HIMS doesn't go to 32. If it goes to 32, I will have to buy, because as I told you earlier, if I sell a put for 32, it's my obligation to buy this stock for $32. I'm ready to buy it for $32. I don't have to have $32 in my pocket right now. How much money I need to have? Again, let's calculate the margin money. 3,200 is the total money for strike price. 10% of this is $320 plus add the premium. 175, 495, so roughly 500. So your investment is 500. The margin money is 500 for this. You have to have $500 in your account to make $175. This is like almost guaranteed, because the stock price was 68. It comes to 44, right? So I don't think it can come to 32. If it comes to 32, I'll be more than happy to buy this stock for 32, and I'll buy it. Okay? But there are not many chances, maybe 10% chances that it might come down to 32. So your 90% chances that the stock will not come to 32. So I will make $175 for sure with an investment of $500. $500 investment, 175, I make 35% return in 2.5 months. That is 35% return in 2.5 months. That is 14% per month return, and annualize maybe 160%, maybe more. That is my return with quite bit of safety. 44, 32. People have bought this stock for 68. Somebody might have bought it for 60. Today the price is 44, and you are committing to buy it for 32. If it comes down to 32, again the same thing happens. So you come up with $3,200 and buy a stock of HIMS for $3,200, and you still keep $175. So 175 is your, so you have 3,025. So net cost of the stock HIMS will be 3,025. So you buy the stock for $30.25. Or you can, if it goes below that, that is your break even. That is your break even. If it goes below like 28, so you pay the difference of 28 and 30, or you take the delivery of shares, this stock. Sounds good? That is, guys, selling put, making money. Okay, I give you two examples already, Micron, AMD, and HIMS. Okay, so the thing is, you have to decide that which stock you want to do. If you are bullish about a stock, then sell the put for that stock and make money without much of a risk. If you buy HIMS at 44 today, it go to 40, you lose $400. Sure, Sure shot. There is no other way. You lose $400 guaranteed, because $44 goes to 40, you lose 42. It goes to 35, you lose $900 for sure. But in selling a put, your profit is limited, but your risk is very, very less. So for 32, you still make $170. If the stock from 44 goes down to 32 in 2.5 months, you still make $175. What a deal. Stock goes up, you make money. There are 3 possible things. 44 is the stock price. 32, okay. There are 3 possibilities for him stock to do. 1, it stays at 44. It goes down to 32. It goes up 45, 46, 47, 60, 70, 80, whatever. So one possibility is go higher. Second possibility, it stays here. Both these possibilities, you make $175 for sure. Okay. If it goes to 41, 40, even if it goes to 32, you still make $175. So out of 3 possibilities, 2 plus more than half of here. So 2.5 possibilities are in your favor. What are the odds of you losing money? And when it comes to 32 or below, you want to buy this stock because you love this stock. You love HIMS. So you always pick up a stock to sell a put which you want to hold, which you want to buy, which you want to have in your portfolio. So selling a put makes you sometimes buy a stock at a much cheaper price, and you get a premium for that. What a deal. Alrighty guys, so these are the stocks which I did the deal today. So selling put options. Watch some videos. How to make money by selling puts. You would love to do this. So you have to have little amount of money in your bank, and with little amount of risk, you can make guaranteed amount of money every week. You can sell these options, calls or puts weekly, monthly, 2 months, 6 months, 1 year, 2 year. The more far you go, suppose 1 year, you will get huge premium, because the more the time, the more chances that the stock might fluctuate up or down. So more time duration, more premium. So right now it might be like little confusing to you guys, but each week I'll make a video by showing you which trade I did and how much money I made, and I'll add some screenshots of the deals which I did today. So I'm not just talking, I'm doing it, and I'm making money in front of you. And you can make money too if you follow this little easy way. So you can master this in some time. It will take time, but in the beginning, I might try to teach you how to do it along the way. But again, I'm not a financial advisor. I'm not charging you any money. This is only for teaching, for guiding people who want to learn, because somebody teach me. I learned from YouTube too. And I'm so happy that I learned, and I'm making good amount of money. My living, I retired at the age of 55, and I'm just doing it full time, making YouTube videos, enjoying my life with my wife and my dogs. That's my life. If you want to attain financial freedom, sitting at the beach, just like spend 10-15 minutes a day, or not even a day, like once a week, you just keep looking, because 2.5 months is time period. So for 2.5 months, you don't have to look at it, right? After 2.5 months, the money is yours, the premium is yours. That's how it works. It's so simple. Believe it. It is so simple. I'm not giving you any advice. Do your own research. And if you want to do it, make money, make your life better. I'll try my best to teach you what I know, and tomorrow you may be expert enough to teach me, right? So guys, take care, best wishes. Any questions, please make a comment and I'll try to explain your doubts. I know there will be a lot of questions. Like the video if you think I have added some value, and subscribe to the channel. Tell your friends, like this video, subscribe, and try to make some money. Thank you guys. Take care. Bye bye.